in real or inflation-adjusted GDP in the United States over time. In terms of value, the US produces approximately 17 times in output today than it did in the 1930s. Indeed, increases in output, not in volumes of money, is what makes a country wealthy. The central bank could print and distribute money as it wanted, making everyone dollar millionaires, but we would be back at the same place unless national output increased as well. The most common way to estimate GDP is the expenditure method. Here, we sum up the output finally used in various sectors of the economy. The simple idea is that if we add up all what we have spent on final goods and services, then that must equal the total value of all output produced in the economy. Note how this idea maps into the definition of GDP as the market value of all final goods and services produced in a country over a period of time, usually 1 year. What you see now is one of the most important identities in macroeconomics. Expenditure categories are defined in such a way to prevent double counting. For example, while consumption includes pretty much all spending by households, business investments does not include all spending by firms. Investments are expenditures that are made to increase future output, so short-term expenses, such as those on raw material, are not included. We also subtract imports as output consumed was from a foreign source and should not be included in the national output. Similarly, we add exports as output produced in the nation was consumed elsewhere. Government spending is a large category and may or may not include government investments depending on how it is defined. Importantly, government spending does not include transfer payments like welfare, as those are not related to production of new output. Understanding the makeup of GDP can help you to understand where GDP growth is coming from, as the growth in GDP is nothing but the growth in its constituent elements. For instance, we can now see how government spending can increase GDP growth in lean times when household consumption and business investment are low.